Billy Gilmore, Aberdeen Asset Management. Welcome to SuperReturn International 2016. Thank you for joining us. You've talked today a lot about the relationship between GPs and LPs and how that's evolving.
Yeah. I have, and I think we have to recognise that private equity as an asset class is maturing all the time. It's no longer a cottage industry. Yes, it's fair to say it still takes up a relatively small proportion of M&A activity, but the industry has grown, I guess, over the period that SuperReturn has been running many times. So I think there is a different dynamic at work today, and of course, as in any maturing industries, the players on both sides look to, if you like, adapt their strategy, whether that's LPs by perhaps looking to do more co-investment or to take advantage of separate accounts, or GPs having more than one investment strategy.
Do you think that's a natural evolution, as you say, or do you think it's also sort of slightly forced upon the industry because of the current economic global climate?
I think it has arisen on the LP side simply because it's been a very strong period in recent years for distributions. The amount of money coming back from private equity funds is much more significant, and that has been deployed in new transactions. So in these days of low or even negative interest rates, that money has to find a home. And I think private equity has, over a long period of time, demonstrated strong absolute return characteristics. I think that is the driver for LPs putting money at work. The danger, of course, is that too much money floods into the industry at a time like this, when we do have macroeconomic uncertainty but still high pricing. And I think that's the fear, that the supply-demand equation, in my view, is somewhat out of kilter at the moment, and we've seen in the historic cycles that can be quite damaging for returns.
And it's a tricky situation out there geopolitically and globally at the moment too.
Yes, completely endorse that, and it is pretty hard, I would say, to read the tea leaves at the moment. So I'm not against managers being cautious and taking their time to find the correct investment opportunities, but I think the issue is, there's a lot of shadow capital out there that is in the hands of co-investors, and they are looking for that money to be put at work. So the danger, of course, is that the GPs could cave into that co-investment pressure and end up doing the wrong deals at the wrong time in the cycle at the wrong price.
So who would you, and it's a kind of binary question, I guess, but who do you think are the winners and losers at the moment? What's the best strategy you can employ, if you like?
Well, I think the GP winners are those who have very successfully raised funds in what's been a very strong fundraising environment over the last 2 years or so. If you were in the market early and you got to your hard cap, you're probably you're feeling good today. You've raised the money. We may be into a period of time going forward where it's harder to do that. So I think that's where the GPs have won. I think on the LP side, it's actually harder to know because this is a long-term business, and we all know that the problem with interim valuations is they're wrong. It's a question of degree. So a fund might be looking good today, 2 years into its investment period, having committed half of its capital, but if there's no liquidity, and liquidity is delayed because of moving into a lower growth economic environment, funds that look relatively good today might not look absolutely good when the final analysis takes place.
That was a subject that was talked about by some of your colleagues today, about sort of having a long-term view and avoiding the short-termism of fear of change or something, if you like. Do you think you agree with that?
Yes, I mean, this is all about long-term absolute returns. It's patient capital. I'm talking here mainly about the manager selection side, the primary side of private equity, which is blind pool in nature. And interestingly, having seen the resurgence of interest in venture capital at that part of the conference yesterday, what I've found over the years with venture in particular is it's not over until it's over. Funds can produce strong winners very late in the day, particularly in the venture capital world. So you should never come to a foregone conclusion, but the average life of a venture fund is creeping up all the time. So I think you've got to be patient and long-term in your standpoint. Otherwise, you might call the wrong decision at the wrong time.
And one of the subjects that was talked about yesterday was this issue of stockpiling for exits too.
Yes, yeah. Well, you see, I thought there was a fascinating comment made in I attended also the German day yesterday, and one of the panelists I thought very eloquently said, "My exit is your entry," and I think that is the stockpiling is there, and I think in Europe at the moment we are seeing secondaries as a key component of liquidity transfer. I think it's less than that in the US. I think there's more strategic buying activity. IPOs I think will be harder to come by just given stock market volatility and the uncertain economic outlook at the moment. So this is the question for GPs. If you've got an offer on the table now that kind of gets you towards your base case return, do you take the money off the table and make an acceptable return, or are you so convinced by the prospects of that business that you're prepared to hold for a higher multiple to be generated in 2 or 3 years' time? And that's what we LPs are paying the GPs to do, to make those calls.
That's who make the big bucks. Those guys who make those decisions.
Couldn't possibly comment.
What do you think we'll be talking about in 12 months' time? Can you predict what the next 12 months what will come to a head, if you like? What will you and I be sitting here in 2017 discussing?
Yeah, I worry that we'll be talking about a very quiet year for new investment, simply because of the market dynamic, the uncertainty that we face. I don't think many deals have been announced so far this year, certainly in Europe, and those that have been announced have been relatively small compared with the fund size that GPs are managing. So I think this supply-demand imbalance could be exacerbated. I think we might see further fallout in energy funds, just given what's happening in the oil and gas sector. And I just wonder if there'll be perhaps 1 or 2 failures of deals that have been done in recent times, perhaps with a hefty co-investment element to them that will maybe just force people to think again about the merits of co-investment. It's great to say it's a cheaper way of investing, but it only works if you choose the correct companies in which to co-invest.
Billy, thank you so much for joining us. Good
Thanks,
to talk to you.
Thank you.